Good afternoon, everybody. Thank you for joining us for today's webinar on how we can make retirement easy with Sphere. One of the key intentions behind having this conversation today was that we wanted to talk about retirement planning and how there are a lot of challenges that most of us face when it comes to saving for retirement in terms of what kind of products that we can choose or what our requirements are and whether there's like a market that serves our specific needs. This uh, conversation is going to be a lot about how we're looking at retirement, what we need to look at, as well as how we should be investing for retirement. And in that, we'll also talk about the ideology behind creating Sphere as a PMS and how that has turned into a retirement savings vehicle. Uh, Whatever questions you have, I'll be happy to take them towards the end of the webinar. You can type them in the chat box, and anything else that you have, if you're not able to hear me, etc., please leave that also in the chat box, and I will attend to that. Without further ado, let me begin with how we can make retirement easy with Sphere. So, if we think about the landscape of retirement, it used to be quite simple before because most people would work at one or two companies through their whole life. So, there weren't too many career changes that were happening. Uh, and because you kind of stayed in one place for a really long time, you accrued a lot of retirement benefits by working in one place. So, whether that was in terms of gratuity or in terms of pension, and it was quite common to have these pension schemes, right? And there were limited investment options also, say, in the previous generation of retirees, because people only looked at safe government schemes, or there would be a few blue chip stocks. But today you have a lot more in terms of investment options, and even in terms of what kind of pensions that you were guaranteed, like in a government job, those kind of things are also changing, right? And even from a social lens perspective, the way that retirement used to happen before was that people would live in joint families, which meant that part of your financial needs were taken care of by the next generation. In exchange for certain other benefits, right? Retirement used to be easy a few decades ago, and today it's no longer the same story. And we need to look at what has changed. It's not that simple anymore because you have multiple career changes. You also then have limited retirement benefits. Of course, your EPF is still transferable. So, as long as you're in a salary job, that one investment is going to continue throughout. But let's say you work in a new age company, you may not get you may not be able to contribute fully to your EPF, or most people tend to do the basic minimum. You might also receive compensation in the form of ESOPs and things like that. You have a wider variety of investment options today. You have more access to global markets. You have more access to a lot of other things. And more, the trend that we're seeing from a social perspective also is that self sufficiency is becoming the key, which means that we become solely responsible for our retirement comforts and how we plan our retirement as well. So, what is it that we need to do to make retirement easy? So, the first thing, of course, is knowing how much to save. And there's no one answer for everybody, right? It depends on how much you're going to spend during retirement. It depends on how much you're able to save up until retirement. It depends on what kind of health conditions you have in the years leading up to retirement. It also depends on who your dependents are through these years, right? If we tend to have children later in our lives, then probably for some time during our retirement, we would have to financially support them. Now, with life expectancy also increasing, there's a very good chance that we're supporting another elderly generation. So, all of these things will influence that number of how much to save. But it's important to keep some target and adjust that target year on year based on how your life is changing. The next thing that can make retirement easy is to actually begin a little bit earlier. Now, what tends to happen is people look at retirement only when they're closer to that timeline. So maybe 3 to 5 years before they're going to take that plunge is when they get serious about doing these projections and figuring out how much they need to save and where all of their assets are. But this is something that if we start maybe 10 or 15 years before your retirement timeline, you give yourself enough time to make these adjustments and be more prepared for a better lifestyle once you retire. And another key thing is to save consistently. Of course, the PF contributions are one terrific way to make that regular savings habit, but we also need to look at investments outside of your traditional fixed income options or your pension schemes, right? You are looking at providing for 20 or 30 years of your life expenses in your retirement corpus. So we do need to have a more dynamic and a higher growth approach, and this means that for the entire time that we're working, we should also be preparing for the time that we're going to be more relaxed and retired. There is also this need to shift between asset classes, which is what I was saying. Outside of your PF, there has to be a supporting structure that is uh, propping up your retirement aspirations. And we also need to simplify decisions. So if there was a way to sort of make sure that we were able to consistently save towards retirement without being too stressed by the financial decision making process, because this is something that you have to do continuously, but you don't want to be bogged down by this, right? So this is what can make retirement easy. And I'm going to illustrate the whole retirement, pre-retirement, post-retirement exercise with a case study. So let's look at Sundar's retirement story. So he's about 45 years old and he recently quit his tech job with an MNC. And he's got a great career opportunity to to work in this startup as a CEO, CTO. And he wants to retire in the next 15 years. When he thinks about how much he is going to spend during retirement, he thinks that it's going to be around 1.5 lakhs per month through his retirement years, obviously adjusted for inflation. So, how much do you think Sundar actually needs to save up for his retirement corpus, right? Let's assume he lives till about 80, 85. Please type in your answers, or let me just start a poll. Just give me 1 second to do the poll. Okay, we have one guest for. So how much do you think Sundar would need to save up for retirement? What should his target retirement corpus be like if he's looking at spending about 1.5 lakhs per month? Okay, great. We've got a variety of answers. I think few people are leaning towards 5 crores, few people are leaning towards uh, 12 crores, and a majority of you are looking at 10 crores. The right answer to this is actually 10 crores. If you're looking at 1.5 lakhs per month and you're going to retire in 15 years today, for a period of maybe 20, 25 years, you would need a minimum of 10 crores, right? We don't do 40 times annual expenses, uh, primarily because we also have adjusted this calculation for inflation through the retirement period, right? So anywhere between 10 to 12 crores is a safe number to save. 5 crores is going to leave you a little short change. You'd probably be living at half those expenses. And the additional buffer of 2 crores helps because let's say you have dependents or you have some post-retirement goals. If you've had children a little later in life, or if you retire a little earlier in life, then you might have some financial dependence outside of your day-to-day retirement requirements. So it's the answer is somewhere between 10 and 12 crores. Okay. So once this job change has happened, Sundar actually really needs to rethink how he's saving for retirement. He received a big gratuity when he quit the job because he'd been working there for many years in the MNC. So he had to think about how he wanted to reinvest this sum of money because ultimately he wanted to retain that mapping. It's something that was meant for retirement. It's something that he wanted to uh, sort of have during retirement. and he contributed minimally to the PF in the new company because most startups only do the basic minimum contribution and they don't do the full 12% contribution that you're allowed to do. And now he's also getting compensated with ESOPs. So a lot of the traditional saving options are out of the window, and he needs to look at how he's going to plan his retirement around these new constraints and what he can actually do. So if we think about how Sundar was investing prior to this job change, he was quite hands-on because he would look at which asset classes were performing well, and whatever was doing well, he would start allocating into them. Then he also spent a lot of time deciding when to buy something, right? And he would read these reports on social media. He would talk to some colleagues in his office, and he had a few. He was quite active as an investor. But the challenge that he was facing was that after he made these decisions, he often did not know whether he should get out, whether he should scale up, or when to exit the investment. And in hindsight, he would have always thought that, okay, I should have done this then. But he felt that process wise, he was not very confident and he was quite confused by how the markets actually operated, right? So for somebody, and I'm sure this is something that a lot of us can actually relate to because we make these financial decisions. There's a lot of support in the buying stage. There are a lot of people who talk about when to buy into an idea or what is performing, but there's very little guidance on when to exit, right? And then if we look back and we rewind, then it seems quite clear as to when we should have exited. So let's talk about the deciding factors when it comes to where our returns are coming from and how our returns are going to be structured. So what we actually think or what Sundar thought was that he needed to figure out when to buy things and when to sell them, right? So market timing was really important. But according to this study on what influences portfolio returns, you see that 90% of that is just your asset allocation. So deciding where to invest or which asset classes to invest would determine 90% of how your returns turn out, right? And then there's another 5 odd % that is going to be based on what investments you make. So yes, it does matter. The stock that you pick or the mutual fund that you pick contributes to 5% of the decision framework. And when you begin and when you exit is about 2%. And there are 2% which goes into all the other factors that could influence your portfolio return. So most of us tend to concentrate our time on security selection and market timing, and we miss the big picture in terms of asset allocation, right? So, what we actually need to focus on today as people who are saving for retirement is to decide where or which asset classes are going to work for you in this market cycle. It's not so much about is today a good day to invest? Should you wait for the market to correct? Is the market too overheated today? Or it's not all of that. Of course, that it's not that it has no bearing, but it's definitely also something that we need to think about whether you want to devote so much mind space to market timing alone. So when it comes to asset allocation, the lesson that we have learned is that everyone is a winner, right? Whether it's gold, whether it's mid caps, whether it's real estate, whether it's small caps, whether it's global stocks or large cap stocks, everything can be a winner for you at some point in the market cycle. And when everything is a winner, that means we need to pick the winners a little bit ahead of time. So what I mean is that winners can quickly become losers, right? So if we look at, say, gold between 2018 and 2023, right? In 2018, you would have felt, okay, it's not doing so badly, but it is top of the pile, right? Then you have two really good years in 2019 and 2020, where you have double-digit performance from gold. And then this is where investors start developing confidence. After 2 or 3 years of good performance is when they feel that this is the right investment for me. And when you get in, you see that last year's winners have actually become this year's losers in 2021. And you can actually take a look at this chart, and I'm sure you'll find multiple examples, right? So you can see small caps 2016 bottom of the pile, 2017 top of the pile, 2018, 19 bottom of the pile, then 2020, 21, 22, 23. We've had like fairly good years for this theme. So nothing really stays in the top forever. Nothing stays at the bottom forever. Everyone can be a winner. It's just about knowing where we are in the cycle and trying to allocate wisely based on that. If we chase performance, then we don't really get the returns that we're chasing, right? We only when we start chasing performance, we're only taking on more risk. So this is one key lesson that we have from this chart, right? That there are winners, winners keep changing, and the solution is not to chase performance. So when we look at multi-asset investing, this is the key advantage. When the market corrects, sorry, let me just go back. I wanted to talk about one more thing. The other thing is that what you will realize is that you never have a year where everything does badly, right? There's always a year where even your best performing asset is giving you a decent return. So, but you do have years where all assets do well, and that happens about 50% of the time. So if you just look at the bottom row and you count the number of years where the thing at the bottom is positive, you'll realize that 7 out of the last 14 years have actually given you positive returns across all asset classes, and 2023 was one of those years. When we know this, right, that makes a great case for asset allocation because you can't really go too wrong with this strategy. Even in the worst of times, you have something that's doing well. And in the best of times, you have everything that's doing reasonably well. Yes, if I take the best year, I'm not going to, let's say if you have a multi-asset strategy, it's going to be very difficult, say in 2023, for a multi-asset strategy to outperform a small and mid-cap strategy. But at the same time, it's not that the multi-asset return is going to be low, right? So this is what builds the case for multi-asset investing. And if we look at how this works, you see lower drawdowns on the portfolio when you have a multi-asset portfolio, primarily because you have a combination of assets. And at different points in the market cycle, different assets are working for you and doing different things. So when, let's say you're in an overheated market, cash is actually protecting you from drawdowns. Or if you're in a high geopolitical risk scenario, gold might have some hedging effect on your portfolio. So this is what a more holistic portfolio looks like, where you don't have too many drawdowns, and this gives investors a lot of comfort to stay invested over longer periods of time, and that's precisely what we need when it comes to a long-term goal like retirement. The second thing that I wanted to point out is that you have competitive returns even at the peak, right? So it's not that if you choose a multi-asset strategy that you're not going to do well in the years that you have a bull market or something like that. You will land up with very reasonable, with very good returns. Maybe not the best, but you never want to benchmark against the best because the best, as we saw in that chart, could quite easily become the worst, right? And you never know in advance what is actually going to do well. So you might as well look at the whole pack. There's nothing wrong in doing that. So when you see this, when we say that multi-asset investing is lower risk, right, we don't mean that it's lower returns. What we mean is that there's less dispersion in your returns, right? Which means that, let's say, an equity strategy can sometimes be down -10 or -20% and can sometimes be up +30 or +40%. With a multi-asset strategy, you're probably going to be somewhere between 9 to 15% on a consistent sort of basis, and you can have some outlier returns as well. So the less dispersion actually gives us more certainty, which is something that we need when we're doing our retirement projections. Of course, there's going to be a range of returns. You will have good years, you will have bad years, but the relative level of certainty in a multi-asset strategy is going to be higher. The other key thing is that it's very suited to continuous participation. So for somebody who is a salaried earner trying to save for retirement, who wants to do something for their retirement corpus month on month, right? Then you're investing through the market cycle. You get to participate in multiple different investment ideas. You can bring all of your investment ideas into one product, right? So this is why multi-asset investing really works. And because you have this uh, reasonable or attractive level of returns and a lower level of risk, it actually suits a wider range of risk appetites. So it's not that multi-asset investing is meant only for conservative investors, or multi-asset investing is only going to give you a very average sort of return. You can do much better. You at the same time, you don't have to compromise on risk, right? Meaning you don't have to assume a lot of risk to do well. And that's the core of why multi-asset really works. So coming back to Sundar's retirement story, I think after all of this, he was a little convinced that multi-asset investing was the way to go for his retirement corpus, because what he was getting in return was that he would have a flavor of different investments. He would have a much smoother journey because the dispersion of returns was actually lower, and he would also have above average returns. So that was comforting because he didn't want to go with a low risk, low return kind of product. And it was a smart retirement solution, allowing him to really save consistently towards retirement. Now, how could Sundar actually go about multi asset investing? Should he look at multi asset mutual funds, or was there something else that he could actually work with? So if we look at sphere versus multi-asset investing, I think there are three key differences that we're going to look at. So the first is in terms of allocation limits, right? So when it comes to multi-asset funds in the market, we need to be conscious of the fact that they are designed to be 65% equity and 35% multi-asset, primarily because a lot of the funds want to retain the tax advantage of having a 65% equity portfolio. Now, tax should not necessarily be the determining factor in what your asset allocation should be, because in a year where you're expecting high drawdowns from the market, a 65% exposure can be excessive, right? So having a little bit of flexibility, or actually a lot of flexibility in the mandate, is really important. And if we look at how our PMS is structured, we are looking at a 0 to 100% allocation in all asset classes. So depending on where we feel the market cycle is, um, we will have depending on where we feel the market cycle is what influences the asset allocation decision per se. Now, does that mean that mutual funds are going to be necessarily significantly more tax efficient than a product like Sphere? I think what we need to understand is that we are tax conscious. It's not that you're ignoring the tax component when you're making an allocation decision. We do understand that there is a tax implication for investors who are choosing this product. But at the same time, we don't want that to be the first or the primary deciding factor in what your asset allocation is going to look like, right? So that is one thing. And if you look at a blended sort of, let's say somebody is in the 30% tax bracket, and you pay 10% on your long-term capital gains. And if we look at a blended sort of tax rate, right? Let's say in a particular year, I want to take the higher tax investments to 50% of the portfolio and the lower tax investments to 50% of the portfolio, then I'm probably going to net end up with a 15% sort of tax rate, assuming a full liquidation of the portfolio, which typically doesn't happen, primarily because we look at investments as a longer term journey where we're looking at 3 to 5 or 3 to 7 years where we're going to be invested in an investment idea. But for a full liquidation strategy, that would mean maybe a 15% tax rate on the overall portfolio compared to a multi-asset fund, which is going to give you 10%, right? If we look at again how multi-asset funds operate in the ecosystem, you have very simple vanilla ideas. So if we look at how, let's say, they play the precious metal space, you had primarily just uh, gold ETFs. But when we look at what we've done in Sphere, we've looked at gold, we've looked at silver, we've looked at some global gold mining companies as well. Similarly, when it comes to global exposure, you would see just a few handful blue chip stocks in these portfolios. But on the Sphere side, we do some research on some ideas on how that could work. Um, and then additionally, I think you also have the core of Sphere is basically thematic investing, right? So we look at themes and ideas that have a long-term story, which would suit somebody who's saving over, say, a 5, 7, 10 year or longer horizon, where you can do some serious long-term investing and continuous participation on these ideas. Okay, so I'm just going to share some data because I think it's important at this point to look at numbers as well and not just talk about the qualitative aspects of multi-asset investing, because there is this hang up that, let's say, you have a multi-asset portfolio that's really not going to outperform like an equity portfolio. So I've taken an aggregate of multi-asset as well as flexi cap mutual funds in the market that are available today versus Sphere. And this is based on, sorry, it's not November 30th, it's December 30th. Sorry, November 30th. Um, so if we look at this data, Sphere has done about 7.5% on a 1 month, almost 20% on 6 months, and 25% on a 1 year, and 22% on a 2 year basis. If we compare this to multi-asset funds in the same time frame, we've outperformed by a very large margin. But let's also look at FlexiCap, right? Because FlexiCap is a pure equity product, and you can see that even for FlexiCap, we have outperformed on this level. So this is basically where you're seeing your outperformance. Multi-asset does not mean that you have to give up on returns. So you get a better risk profile, you get a better return profile as well. And um, just to share our December 31st performance data, this is where we are. And now I will open up for a question. Sorry. Oh, sorry. Not Q&A. I think I just shut the presentation. Okay. All right. So just a couple of more things before we open up for Q&A. So with this, Sundar found his retirement solution, and now it's your turn to think about that. I also wanted to share some testimonials from our clients where they primarily talked about how this has allowed them to retire quite peacefully in terms of not having to worry where they're investing, how they're investing, or making those day-to-day decisions where they're able to enjoy their retirement, knowing that there's one part of their portfolio that's working for them. Um, I also think that, yes, we do have a shorter track record in terms of 2 years, but this is a commitment that we are willing to work on for the long term. And our product ideation actually started about a decade ago when we used to have an RIA practice and worked with clients through that cycle, right? And this is just our overall PMS team structure. We have 4 products. Sphere is one of them. And we have, as you can see, a lot of people who are contributing to how this product works for our investors. Yes, we can get to Q&A. I already see one in the chat box. How does your product work? In what sense do you mean? Are you asking in terms of uh, like fee structure, or is it about what we put into the product in terms of investment ideas, or how? I'm sorry, I don't fully understand that question. So this is a PMS regulated by SEBI. So there is an initial requirement of 50 lakhs by SEBI guidelines. But beyond that, it's per investor's choice. We do encourage both SIP as well as lump sum into the portfolio. Um, and it's basically according to each individual saving capacity, as well as if we would like to start with a retirement projection, then we can work backwards and see how to scale up the portfolio. You're welcome, sir. You're welcome, sir. Do we have a common platform for investing in Sphere? Yes. So the way to invest is we need to do an onboarding and we need to start your investments. And then there is no, so you will get monthly statements, but there's no platform where you have to participate. The whole idea is to sort of give you a more hands-off and comfortable approach in following your retirement corpus. And of course, we do interact regularly with clients as well as public investors in terms of what we're doing. So that if you like a one-on-one conversation at any point, I'm sure that can be arranged with the team as well. Okay. What happens when the initial investment falls below 50 lakhs? Does it continue to be a PMS? Uh, so I think the regulatory requirement is that you need to have a minimum of 50 lakhs. And there can be, I think, some market variation, probably like in the first couple of months while the portfolio settles down. But beyond that, like we've not really had a case where it falls below 50 lakhs. Um, of course, like if an investor takes out money, then until the corpus comes back to 50 lakhs from a regulatory perspective, you cannot execute any transactions or trades in that account. So that restriction is there. Sphere versus Nifty 50, compare the returns and advice for 52% suitable investment MF or PMS. I think we have outperformed the Nifty also in, so I think I can check and give you that this thing. I will take your contact details and probably share that with you once we have some compliance clearance. Um, you can definitely look at Sphere as part of your retirement corpus, sir. I think if you're, say, 52, 8 years is a good timeline where you can look at this product. Is my voice audible to others, or is there some audio issue? Tarun, could you let me know? Okay, great. I see that I am audible. Is it advisable to take other PMS products like TrueBlue along with Sphere? Yes, actually, the ecosystem that we have within iThought PMS is quite complementary. So if we look at what each product does, right? So you have Sphere, which is your multi-asset product. You have Vriddhi, which is a higher growth, slightly more aggressive strategy where you're looking at small, mid, and micro caps. And then you have TrueBlue, which is your truly blue chip portfolio. And you have Solitaire, which is your flexi cap. So if you look at all of these, like depending on your risk profile, you can combine two or more products, and they all have very specific goals. So I think in terms of overall complementing each other, that works. Okay, instead of PMS, why don't we rather look at simple hybrid debt funds having minimum 35% in equity to get rid the old 20% indexation, or multi-asset funds with hybrid taxation? Wouldn't they be more beneficial? Yes. So from a tax perspective alone, I think you do have that benefit if you look at a mutual fund. But I think that's pretty much all that it offers you, right? If I'm able to outperform a mutual fund significantly enough, right? And we saw the gap, like let me go back and show you that slide. So if I am doing, say, uh, 20 odd percent versus say 15 to 18% on, like if we look at the high, so if I'm looking at multi-asset funds, right? If there's like a 5% difference, then I don't think the taxation is really going to affect you. It's more about the quality of the product, right? The performance will come if we're following a particular process, and I think net post tax you can do better. Which is why I said we are tax conscious. We do keep that in mind, but we want to look at asset allocation in its own merit first. That is what we're committed to first. Whereas if we look at how the mutual fund products are structured, it's more based on the taxation. That's why you have the products within certain mandates. And as an investor, I think sometimes we need to look beyond tax, because let's say these are all policy changes, right? Few years ago, you were not paying long-term capital gains on equity. Now you're paying slab rate on your fixed income investments. These things keep changing. So your investment strategy needs to be more aligned to who you are and what you want to achieve, rather than what is the tax flavor of the month, because that's not in our control at all. So I think if we look at our current distribution, we are slightly heavy on equity. So we would be close to about 70% in equity, and then we have maybe 5-10% in precious metals. We have another maybe 3 to 5% in debt, and then we have some in global investments as well. That would be our overall asset allocation, but that can change with time. And if we look at where we feel in terms of market cycle, I think this could be a good year for fixed income investment. You might see a little bit more allocation there. You may also see some hedging in terms of uh, how the overall portfolio is structured. We do not have a lock-in period for Sphere. We were very conscious of keeping that in place, because we do know that some of the people that we're working with are close to retirement. We want to make sure that this product works for them. What we do recommend is to come with a slightly longer investment horizon, so that you can benefit truly from being invested in this product. When we add more funds also, there is no lock-in period. So there is no exit load, there is no lock-in. We've kept it very simple. The fee structure also is quite simple at 1.5%. We don't charge any variable fee for performance. Okay. If we are looking at a 10+ year horizon, does it make sense to invest in a riskier option like Solitaire? Because an additional 1-2% over a large horizon can make a difference. 100%, I think you should make this decision based on how much risk you are comfortable taking, right? Or what your overall asset allocation looks like. Let's say you're a heavily equity investor, you want a slightly more multi-asset approach, then Sphere would work for you. If you feel that you want a slightly more aggressive approach, you're not worried about the drawdowns in the portfolio, then it makes sense to take a product like a full equity product, say like Solitaire or Vriddhi or whatever you have. Because like you mentioned, that 1-2% over a large horizon does make a difference. You don't want to ignore that. But at the same time, if that drawdown is going to impact how you respond to participating in markets, I would suggest, like, for a smoother journey, the end goal is to get you to retirement, right? So in the most comfortable way possible, whatever that is for each person, that would be the best product to take. No lock-in period again. So how does your PMS work? Let's say 50 lakhs are invested in the first year, returns are 20%. Do I receive the returns or you reinvest? So whatever the returns are, they accrue in the portfolio. We don't distribute any returns to investors. And typically on a 1-year basis, we may not actually enter, exit an idea. So if there is a requirement, then the investor, of course, is free to take draw down from the profits, but that's not the intention of the portfolio construct. We want to help you use this product to compound your savings for retirement, which could be many years away. But whatever requirements there are, we have been able to fulfill from clients whenever they have asked for money. Yes. Chasing returns, yes, we don't believe in chasing returns. So if you see our entire philosophy across all products, we are very conscious of uh, where we deploy capital, how safely we can take investors through this journey. And it's not about chasing returns. It is about following a particular process. And we have noticed that if we're a little picky about valuations, if we are a bit picky about corporate governance, if we're a bit picky about quality, and if we're a bit picky about working with or investing in market leaders, then the performance comes anyway. We don't have to compromise on anything, right, which is safety or security of capital, because ultimately day-to-day movements in the markets are normal. That does not mean there's a loss of capital. The loss of capital comes when it's a little bit more permanent, and that can come from a quality issue, it can come from a corporate governance issue, or it can come from buying expensive stocks, which are all things that we are committed not to doing in this product or any of our PMS products. Do you recommend any product in mutual funds to build the retirement corpus until we build to 50 lakhs to get into Sphere? Yes, actually, we have a really good program called Milestones to Wealth, where we work with investors no matter where they are to get them to 1 crore. Now, when they hit the 50 lakh milestone, it's the investor's decision whether they want to continue in mutual funds or whether they would like to open a PMS account. But that's a fully guided program in the sense you have weekly interactions, you have a lot of um, sort of discussion on investment ideas, on behavior, on helping people reach or cross each of those milestones. And there's a good level of hand holding that will get you from wherever you are, right? So we have people who are saving few thousand rupees, we have people who are saving few lakhs of rupees, and it's curated so that you can get to your first crore. Uh, Okay, so back to this question. Fine, leave out tax, but your focus is harping only on returns mostly, but not safety and security. I hope I answered this question because I did come back to that in terms of what our metrics are in terms of ideation. We aren't chasing returns. I'm sorry if I've made it sound like that. What we do is focus on quality and valuations, and that is how we are able to deliver the returns. It's not that I'm chasing the returns and that's how I've done it. Okay. How much SIP amount would you recommend and how frequent? So the SIP amount, again, according to each investor, but you can work back. So you can get in touch with us. We can back calculate and tell you what you need as your retirement saving. And but ideally, I think 1 lakh or even 50,000 would be like a good starting point, but it can be much higher as well. Right. We do not have any AIFs. It's a fixed fee of 1.5% based on the daily value of the portfolio. And um, yeah, it's a fixed fee of 1.5% based on the daily value of the portfolio. And the collection happens on a quarterly basis. Uh, Apart from your PMS charges, we have to pay any brokerage and MF commission. There is no MF commission. There will be some incidental expenses in terms of brokerage or custodial charges, which are not, and GST, which are not included in the 1.5%. So any other transaction costs are at actuals. Do you also have return-based PMS charges option? On Sphere, we do not. I think on TrueBlue, there are two fee structures. One is a flat fee structure, and one is a structure that is based on performance, right? So there is a hurdle and there is a high watermark. So based on whether the returns cross the hurdle or not, there is a fee structure that is available in TrueBlue. Yes, equity dividends are also reinvested into your PMS only. It does not go to the investor. Okay. So I think we began in just 1 second. I've been getting multiple calls. Let me just take this for 1 minute. Apologies for that disruption. Um, Yeah, we do not reinvest equity. Sorry, we do reinvest equity dividends. It does not go into the investor's account. It comes back into the portfolio. We started in 2021 December, so we recently finished 2 years. And I will share the drawdown data. I don't have it right now. I think it's about 11% is the maximum drawdown. We are relatively recent. I don't know if there is any PMS institute which has ranked us, but on a monthly basis, I think there are, like, depending on how the performance is, sometimes you do see us on PMS Bazaar reports in terms of top performers. But that's like a monthly metric. That's not our long-term objective. We do want to work with clients over like 10 plus years. Currently I'm making SIP and MFI. I thought, how can I move to Sphere? So I think if you've reached the 50 lakh milestone, then you can definitely talk to your point of contact, or if you could just drop your name in the chat box, I will ask our team to get in touch with you and they will assist you with this transition process. What were the mistakes in Sphere until now? Top three. I think that's a tough question to answer in terms of, I think, see, sometimes they're early because we are a little contrarian, so you will see a little bit of drawdown. But I don't think we've really made a mistake in the sense where there's been permanent loss of capital. Uh, that is definitely one thing. We have not changed any PMS product managers. So for us, it's been basically Shamsa who's been the fund manager on the scheme. And we have a team with Niranjan sir, me, Harshil, Roshan, and a few others and our entire research team who's supporting us in this process. Okay, how many clients do you have? So I think by close of 2023, we had about 230 odd clients. Okay. Thank you, Dinesh sir. I will ask your point of contact to get in touch with you, and they can definitely figure out how to do this transition. I will share the drawdown data as well, sir. Like, I don't have it readily available, but I will. We had it in one of the previous webinars, so I can get it sent across to you. On the retirement corpus shown for Sundar, how was it calculated? Is it monthly? Uh, Yeah, so that's a simplified version of how we did it. We actually adjusted it for inflation, right? So what the monthly expenses are, what they would be in the year of his retirement, and then through retirement, let's say what would the net return between your portfolio growth versus your inflation rate. That is how we arrived at 10 crores. That number is actually like if we do the accurate calculation, it comes close to 9.5 crores and not exactly 10 crores. Um, but that's how we computed it. So this is why we have the milestones to wealth program, sir, because we believe that everyone should have 1 crore in savings. And it doesn't matter where you are and where uh, how much you have on day one, but how do we get to that 1 crore milestone is like a journey that we want to work with a lot of people on. So there's no minimum requirement for you to do your milestones to wealth journey, right? And there'll be somebody who's going to help you cross each of those milestones. So whether it's 1 lakh, 2 lakhs, 5 lakhs, 10 lakhs, 50 lakhs, all of this, these are all different milestones in that journey to 1 crore. And we don't think that this should be something that only high net worth people can do. Unfortunately, the requirement from SEBI is that you can only do it if you have a minimum of 50 lakhs. But the goal that we have for savers today is that, okay, wherever you are, let's work towards that 1 crore. From an operational perspective, whatever dividends are received in the PMS will remain in the PMS account only for reinvestment. It does not get credited into the client's bank account. So we do not do a systematic withdrawal plan from Sphere. So what we do is we work with the client on planning their entire retirement corpus, and Sphere is one part of that. We've not yet had somebody, since it's only been a couple of years, where we've moved out a part of the Sphere corpus into an SWP kind of strategy. But if we were to do that, it would be on a rebalancing basis, say every 5 years. Yeah. So the 21.8% in terms of returns is with dividends, it's post expenses, all of that. Do we have any more questions? So this is not like a product where we can do a consistent cash flow right now. And if that has been the requirement, we have always tried to structure it outside where in a product that has more liquidity, typically your mutual funds. And whenever we have clients who are looking at retirement, there is like a retirement planning exercise that goes into figuring out which part of their assets is going to go into the compounding bucket, which part of the asset is going to go into a income generation bucket, and based on that the allocation happens. If there is some suitability or matching with respect to whether a PMS could work for that client or not, it one of the PMS strategies can be suggested. No, so financial planning is a separate exercise, but it can be done and it can be linked to your sphere investment. I need to check on this about the drawdown, like if it goes below 50 lakhs, because I'm not sure we've actually had an instance where, uh, let's say, like a few months down the line, like there is a drawdown below 50 lakhs and we've been unable to transact. But my understanding is that if it does drop below 50 lakhs, there would be a requirement to top up, right? But let me just clarify that question from our compliance team because I don't want to give you the wrong impression. No, as a matter of fact, we've never had exposure to Franklin Templeton debt funds in the PMS or even on the mutual fund distribution side. We were very active on avoiding Templeton schemes. We've actually written a lot on public record also about how we felt. Our approach in fixed income investing itself is quite risk conscious. We don't believe in taking too much risk. Um, Inception date is 16th December 2021, sir. So I think the custodian for Sphere PMS is ICICI Bank, if I'm not wrong. But your entire holdings are held with the custodian. And it is the demat account is opened in your name. So there is no like Sphere demat account in which this goes. Yes, I think you would need to open a new account for Sphere because they're independent, right? Like for each PMS, you would have to open a new demat account. You can't, I don't think you can use the same account for both products. So this is why I would encourage that maybe you can have a offline discussion with us on what your specific requirements are, because if you say you need income after 5 years, then we can plan around that to see how best to work that through, right? Um, that's what I would recommend because the planning exercise will give us also some level of clarity. Okay, what can the product do versus what are your needs and whether this would be the best option for you, right? Because, like I mentioned, as of now, it's not sustainable for us to withdraw from the portfolio itself on a monthly basis, like how in mutual funds you have an SWP. Uh, I think that is not something that works in Sphere as of today. But I'm sure there are, I mean, in terms of working around, it could be, on average, I think the equity portion is about 70%, like I mentioned. That's our asset allocation split today. But that's not set in stone. That can change depending on how the market moves. Solitaire was our first PMS, so that's our flagship product. I think we started that in 2019. So we're done with about 4 years in or 4.5 years, maybe in Solitaire. And then we had uh, True Blue, I think, and then Vritti, and then Sphere. So actually, Sphere is the youngest in the ecosystem. Yes, sir. This pretty much works like that only. If there is any profit booking that is done, the client is or the investor has to pay the long-term or short-term capital gains wherever applicable. And in terms of reporting, you will get like a tax report that you can work with, say, before advanced tax deadlines, as well as at the end of the financial year, so that you know. Uh, Thank you, sir. Thank you for all of your questions. Hope to see you again soon. I'll just wait for a couple of more minutes in case anybody else has any questions, and then we can close the webinar. All right. Thank you everyone for making time on Saturday to come and talk with us about what we can do for your retirement corpus. I know there were a lot of questions that I have to get back to with data. We'll try to do that today itself. And beyond this, if you have anything else, these are our contact details. Please do get in touch with our team and we'll be happy to work with you. Thank you once again.